Good morning, everyone. Welcome to the room. As you know, trading futures does involve risk. It's not suitable for all investors. Information in the presentations for educational purposes. It's not a trade signal service, not intended to be financial advice. Hope you had a nice long weekend. We are now well beyond our 61.8 of the short, so it's time we pull that off the chart. All-time highs to our lows of last year, so we can get rid of that. Next stop, if you will, you can see on the daily, weekly chart, our halfway back long has now made it to its negative 23 and starting to creep up a little bit more. I would expect a little bit of more volatility this week. We've got some news coming out, or discussion, I guess, around the banking sector, and that may move markets a little bit more than the last couple of weeks with the Fed not raising rates, which didn't really have much effect. I was kind of looking to put on a put hedge going into the Fed meeting announcement. We talked a little bit about it 2 weeks ago, and there really wasn't a great opportunity, or there were opportunities because we closed bullish on plenty of days, but just didn't really see a likely outcome where a sell-off from the Fed meeting last Wednesday was really worth it, so didn't end up putting anything on. Here's that negative 23, and we're now in our September contract exclusively here, with expiration being on Friday. So sometimes if we just kind of break the negative 23, then a little pullback to the negative 23 could be in order here, versus just going straight down to the next 50% retracement long. Like, we don't always have to drop super hard, but that's what it would look like. A 41.67. It would kind of line up with these prior highs, so that's definitely on the radar. We have just gone, especially tech, has just gone up, up, up all year. It's been a huge year so far for the tech sector. Individual stocks like Nvidia have just gone through the roof. So tech is on fire. I know it's not really talked about much, but it is. It is going up like crazy. So that's another good reason why it's always best to stay in the markets. And if you've got a position in tech, let's say, rather than trying to close it out at the top, which is very difficult to do, because all of these little highs could look like a top. This could look like a triple top here. You could say this is a double top. At the time, you could say this would be a double top. And so if you're closing out, let's say you say right here, oh yeah, this is the top. It's kind of end of 2020. COVID's going on. It's things are not looking good. Triple top. I got to get out. And you do get out. Well, then where do you get back in? For most people, it's very difficult to get in the lows, the depths of the tough times when all seems doom and gloom. And obviously, this would be more for longer term your longer term investments. If you're swinging and you just want to get in and get out on all these little swings, that's no problem. But most folks, either you've got some kind of 401k, or if you've got a $500,000, it's still not wise to trade it all. I find that I trade much, much better when I have a bigger chunk of money invested, um, that's just kind of kicking out returns, and then a smaller portion, let's say 10% of that pool of money dedicated to trading. I mean, the leverage is so high with futures, you can do a lot with $50,000. So, that being said, I prefer to keep my long-term positions all the time and add to them, and then just hedge when the market starts to go down. You got things like inverted hammers here. You can buy puts on, catch a big move down, take those profits from the puts, reinvest them into the long position, and then when something like this happens, I think we're up like 35 some percent already on the year. I mean, who coming into this year would have bet that, oh, tech's going to have a booming first half of the year? So rather than try and exit at the top and get in at the bottom, I would much rather just keep the position on for stuff like this that can kind of catch you off guard, and you can keep collecting those profits, those dividends, and sit back and just say, huh, well, that's interesting, and watch your accounts go up, up, up. So a bit of a gap down today. If we, I, I don't really pay much attention to yesterday's price action since the markets were closed, or since the stock market was closed. So our gap fill is up here really from Friday's close. So more than likely we'll have a 15-minute opening range breakout opportunity unless we come up and fill that gap. Or you can just decide to pass because if we come up and fill yesterday's close, if it's a little bit of a gray area, that's fine. Decent range already in the first couple of minutes, 10 points. Sometimes we've had days where the whole 30 minutes is 10 points. Summer is typically quite a bit slower than the spring fall. So if this is your first summer trading, usually volatility comes down. Volatility's come way down this summer than what most folks are probably used to if you've only been trading for 3 years or so. Didn't have any retracements last week, and really just had one minute. I intended to not trade on Friday and Wednesday, and then decided to just take Thursday off since I was already not trading the end of the week, so because of expiration. So just used it as an extended holiday weekend. There were no. We filled the gap on Thursday at the open, so there was no 15-minute anyways. Yeah, we did have another day last week where with the very first candle was a hammer, I think. Um, I I don't I've never placed a trade off that first candle, like doing a buy stop above this hammer, just because you don't really have any context for it. Um, you don't know, well, so this candle is 4.25 points. Is that going to be the average for the morning, or is that going to be considered a large candle? So I don't place a trade right off that first candle, or I haven't. If I am trading pre-market, which I don't do too much, a lot of the times I'm trying to trade in the direction of the gap fill. So like trying to pick up some of these longs down here because at the time, and this wouldn't be today's gap fill, obviously. This would be the unfilled gap from the prior day, which in today's case would be considered Friday. So in that hour before the bell, I'm looking at taking longs. Like I said, I don't do a ton of pre-market trading. I have in the past, but um, that's always been the approach. Taking a look at our unfilled gaps on a bigger timeline, we filled all of them from last week, and we have had a lot of overlap, which is actually a pretty strong market condition when you trade at the prior close. There's 1, 2, 3, 4, 5, 6, 7, 8, 9 or 10 in so far this year unfilled gaps, which is pretty solid. That's not that many. So really, above us, we've got one that goes kind of way back here. Two above us is all we have left before all-time highs, and then a bunch of them, well, some from this year, then a handful going back quite a ways. So coming to the day, looking for the open high or the high-low close of the prior day, that's usually the best reference point of kind of a starting position because that kind of tells you, okay, like today we gapped down, we're outside of Friday's range, so there's likely going to be some good swings. Um, doesn't mean there has to be, but you have a better chance of getting more movement when you're outside of the prior day's range. little bit of indecision here in the first 15 minutes because we've got a kind of a smaller body and it hasn't closed yet, but we're getting there. Another minute, and these the wick on top and the wick on bottom are both about the same size. So that's kind of showing that, kind of like a dragonfly doji where the open and the close are right on top of each other or pretty dang close. Shows that, hey, we opened, went down. It's like this game of tug of war, the analogy that I use a lot. Go down, go up, and then settle back right in the middle. So we're going to be looking at a 42.75 as the long and a 44.31 as the short. So 44, 42.75 is the buy stop to the upside, and then a 31 is a sell stop to the downside. So we can put those orders in, see if whichever one gets filled first, then the other one becomes the stop. Or you can set each one as a bracket order and then have it go when, let's say we go up. If the long gets triggered, then have it be a bracket order so that it throws out a plus 20 and then let's just say a minus 20. So you got a target and a stop. You can delete the well, you can choose to delete the low order and just drag the stop up, or you can leave the low order if you want to take it in the opposite direction and drag the stop up. So now you've got a stop and a reverse order on top of the low at the same time. So this year, and especially when volatility has been lower, a couple of years back, trading the opposite 15-minute. So like if we break to the upside and then that doesn't make it to a plus 20, but then we roll over and break to the downside, trading the opposite direction like that has gotten quite a few plus 20s. I think just, if I look at my log here, just the opposite trades was about 120 points for the year in just taking the opposite. So it's definitely worth it, and that can sometimes give you two trades on the day. If the first one is a stop out, then you have an opportunity to take it in the other direction. Bit of a triangle here, so hopefully that means we're leading towards a pop of some kind. If we go like that, lower high, higher low, getting tighter and tighter. Anytime you have a consolidation, it's leading you towards a breakout. You go to the daily chart, you got periods of trending, periods of consolidation, sideways, up, and just going back, sideways, up, down, up, sideways, up, sideways. Any consolidation is going to be preceded and followed by a trending situation. This little inverted hammer here, not the high of the day, kind of right at the downtrend line, but as we get closer to the apex or the point of a triangle, your opportunity for getting stronger moves towards the other side of the triangle decreases. Let me see if I can say that another way. As you're getting, like early on, you can go like the distance from one side of this downtrend line to the other side of the uptrend line. So one side of the triangle to the other is bigger. And so like this run down here, what, 440? So this is like a 6-point move. Whereas as you get further to the right, now this distance is getting smaller and smaller and smaller. So it sort of cuts down your window of range between the two trend lines here. So tomorrow we've got Jerome Powell speaking. That could be one that shakes things up a little bit. A little bit of a down move yesterday. Even so, let's say we rally today and we kind of have this bull flag. That could be a case for buying some short-term puts. But you wouldn't be... Yeah, we'll see how the day goes. I'm not just buying puts just because the market is up. You don't just want to say, well, the market can't go any higher, so I'm not going to get in this uptrend. Speaking of which, take a look at the NYSE tick and you can see this uptrend forming. I look at a lot of the, I look at trends in the NYSE tick a lot. So Jerome Powell Wednesday, that's Wednesday morning. Thursday is your jobless claims. Jerome Powell speaks again on Thursday. So definitely some good catalysts for up and down this week. PMI on Friday. Nothing today at the top of the hour. I think I just said this, maybe. Maybe it was just in my head, but I like looking at the trends in the nicey tick to help get some relative highs and lows. So like right now we're going kind of up along this blue cyan trend line on the nicey tick. So if we come down here to let's say we come down and we make a double bottom off of this guy, but the nicey tick doesn't come down and make a new low, where are we relative to this trend line? If the trend line's holding and this uptrend line is holding, then a low price and a low nicey tick might only be at the trend line itself. The other thing it's helpful for is if we come down and break that trend line, then a move back up to it, just like typical support and resistance, can then be maybe a little lower than the highs of the day, but then that backside of the trend line could be a resistance point for shorting. So here we're taking out this swing low. So if we were to bounce, a high tick might only be the zero line, kind of the backside of this uptrend line. And we may also get a break of lows today, or here too. Here's a hammer. We're going to go 35 and a quarter. I like that it's just below. It's kind of a double bottom. It's not a true double bottom. We're in a low-ish tick, 56. Not a huge candle. It's a 35 and a quarter. Let's see if it does anything. I'm going to scratch it. We're up at kind of up in these high ticks here. So deleting that. See if we get our low break here. There we go. So, what does a down move look like? Still looking like a bit of a bull flag. Getting a little low within this breakout candle. You don't want the bull flag to go, we're right on the edge, more than 50% before it starts to kind of break down. So this could be that breakdown moment. We do have a retracement short here. 42.50. I was just looking for the next gap fill below us. It's a 43.0750, so that's a bit of a ways away. That would be a nice run. And we'll mark our high and low of the first 30-minute range. This candle's a little big. Not really, I guess. 3 points. Not really in the low tick, though. So it's a 44.32 is the high of that candle. In 3, 2, 1, drop it. Let's see. Kind of been hovering around the 0 line. The high nicey tick is only 332, so we'll more than likely go higher than that. So I was kind of looking at this as the most recent kind of relative highs and lows, this cluster here. So we'll see if it goes up to this apex again, or it looks like a big candle, but it's only 3¼ points. Okay, so stop needs to go up to 31.75. We're 1 tick away. Kind of right on top of this 30-minute low as well. Yep, there it goes. This low wasn't really a double bottom, and we didn't break lows in order to take this as a short here. Would have been nice if we could have got like to the negative 23, or at the very least break lows. Otherwise it's just kind of a higher low, and then this next short it kind of broke the 60-minute a little bit and just kind of retested this 50. But I like that we're at the bottom of the 30-minute range in a highish tick. Just kind of watching for like an inverted hammer here or some type of short. The 15 minutes already triggered short, but not much follow through yet. There's 130.75. It already printed that, but that was kind of the inverted hammer I was looking for. So it's a 30.75. But it's already in process. So anytime that you're kind of moving along a sideways, like a horizontal support or resistance level, the longer you move there relative to the rest of the day, the more likely you are to break down. So like we rolled over here and we weren't able to go lower. Then you kind of put in this higher low. It would have been nice to have a hammer, an inverted hammer like this back here, kind of where this hammer was. Now here we're in a high tick already. We can get rid of this guy. Back at this sort of pseudo downtrend line. Just a rough Rough downtrend line from the morning. Nicey tick still in a more general uptrend. So a little bit of a divergence there. Uptrend in the nicey ticks, downtrend in the S&P. This is our full halfway back, 35.50. Full halfway back on the day. Maybe that will give us some push lower. Otherwise, it might just be a bit of a waiting game for Jerome Powell tomorrow. And what is today? Today's Tuesday, so tomorrow and Thursday. But it's still early. Back at this 30-minute low again. Still not a very high tick on the day. And our low tick was put in right off the open, and then 641. So we need an 11 or 1075 for the plus 20. Within a point of this 50%, so a little surprising that we rolled over before we got there, but could be seen as drawing this high to low. Got you a little closer, still didn't touch. And then no 512 after that, no inverted hammer or any kind of entry point there. halfway there to our 20-point target, down in a lowish tick here. Not that that really means anything here other than watching for a potential bounce here. We passed the negative 23 pretty quickly and all the way to the negative 61.8. So the next drawing could be an extension. So a small bounce and roll over is kind of what you'd be looking for there. I do have a nicey tick video, a couple in the dashboard. If you just do a Control F, nicey tick, you should be able to find those. I would definitely be a little cautious at the start of when Jerome Powell starts speaking. A lot of times there's algorithms or different, trading firms out there that are just going off of certain words, so that's where there can be some erratic spikes around that time. And if you're in a trade and you've already got your stop tightened, that's one thing. Don't necessarily need to close it out entirely, but I would treat Jerome Powell speaking the next couple days kind of like a news announcement at the top of the hour. I'm not going to put on a trade right at it. And at the same time, any time while he's speaking could be a little bit wild. Low tick here at low price, but not really a hammer. Swing highs all the way up here. We're actually getting kind of close to that 20 points. 14 and a quarter might make it there shortly. See how high we bounce here. Let's redraw that extension. Low to low like that. Again, here you're kind of looking at this as a bear flag. You've got these 3 red bars as the pole. So if we made it to the 21, that would be a decent spot for a rollover. And no real swing high break. You have this one green candle here, but it didn't break the prior candle's high. So the swing high is really back up here. Low tick, other than just buying a low tick, which can burn you pretty easily. It's not really a long entry. You could use this 1 minute candle, even though it's not a hammer, but those are really your only options. Buying the low tick outright, which in which case it'd be back here at 21, or just taking along above the high of the low bar. But we're awfully close to the 20-point target on the 15-minute, so I'm just going to sit tight. Got a little bit of consolidation back here from, what was that, last Tuesday that we're kind of coming into, and even this cluster here at the end of the day on Wednesday after the last week's Fed meeting announcement. But let's see if we can't hit this plus 20. Yep, we're at the plus 15. Good eye, Stan. So you can move your stop to -4 on the 15 minute. Um, Really, that's just there to, we're every once in a while you get in a situation like this where you get really close to the 20-point profit target, but you don't make it all the way there. So rather than having the market come all the way back to break even and then all the way back to a full stop out, moving to -4 is just a way to cut down on those few occurrences where that might happen. And this way, you're at least reducing your. I have had trades come plus 16 points and then come all the way back up to around break even and then roll over on like more volatile days. But realistically, if we get this close and we don't make it there, and then you come all the way back up, um, it would take another big push down because 20 points on a day like today, the opening range is only a little over 10 points, so pretty close. See if we can make it there. Oh, come on, little guy. Need that extra tick to get a fill here. Come on, there. Come on. Right on it. Little double bottom, small. Not really, I guess. This candle didn't break the prior candle's high. Yay. Okay, so plus 20 on that 15 minute, and not really any other great short entries on the way down. Um, I suppose that is the whole purpose of the 15 minute. When there's not any other opportunities to get in a short, this gets you in early and allows you to stay in if the market rolls lower. So I'll take it. And so on a situation like this where you get a plus 20, then just go in and delete your. If you have an opposing order, you can just delete that. I wouldn't take an. Like if we came all the way back up to 44, 42.50, I would not then take a long because we've already completed our move to the downside. So why do you need a 1075 instead of an 11? Because if you, I don't know how some paper accounts may fill you at 11, but um, when you're on a real environment, price needs to trade through your order to get it filled. Sometimes it will fill, like basically, in order. Sometimes you'll get a fill when price touches your order. You've probably experienced this every once in a while. It's basically first in, first out. So the first person to put their order in at 11 is going to get it filled, and then the next person who puts their order in is going to get it filled if price comes down to 44.11. But you know, there's so many orders and things are happening so fast in 85-90% of cases, you need price to go through your order to get all of the orders filled, in which you would be one of them. So occasionally I'll get price will come down and touch my order and fill me without going through, but by and large. So if you are on a practice account, maybe they've adjusted this, but I remember first starting 12, 13, 14 years ago with futures. Maybe it was even a little longer than that. But Thinkorswim, price would come down and touch my order when I was practicing on the paper account, and then it would fill me right away, and it kind of made this false sense of reality. So if you're on a paper account, just put your order one tick beyond where you want it to be, so you ensure that you get a fill in real time. Yeah, we've got a low tick at 22, which is back here, but then low price after it. So we could continue to make new lows until we get a new low tick. But then already here, coming up and breaking the 61.8. So kind of a mixed signals there. We had another one back here where we came up and broke kind of the next retracement and then still rolled over. Going back to our topic of the like tech really taken off this year, and just longer term investing, um, rather than see the uptrend, and this applies to intraday trading, or I guess trading in general, rather than waiting till you see the uptrend and then jumping in and then getting scared when the market is down. I tend to put more into my long-term accounts, like put more money in them. Uh, in addition, I just have like a weekly draw set up that comes from my trading account, and it pulls basically pulling a salary off of that account, and then from there, my checking account pushes money to my various long-term investment accounts. Um, but when the market's down, I tend to put more into those longer term investments, even though the market's down and I'm not seeing a big return at that time. I'll put more into the accounts and buy more of those longer term investments. And then when the market's up like this, then at least in this environment, and this kind of happened back in like 2004, 5, 6, when interest rates were even higher than they are now, um, putting more into savings and less in, so I continue my weekly deposit into my long-term account and continue to buy there, but not as heavily. I'll put more into savings and just kind of build up cash so that when the market does roll over, then I have that extra cash to buy when the market's down. And the same thing, we talked about that up here at the end of 21, getting your ducks in a row, getting rid of any costly debts. A mortgage is not killing you, but a credit card, carrying interest is. So using the times when the market is up to build up cash. So then when the market goes down, even if you don't have any debts or anything hanging over you, then you can use that cash to buy more investments when the market's down. So that's definitely the approach you want to take versus, oh, the market's up, I got to jump in. Oh, the market's down, I got to, get out. Now I'm hurting. Now my investments are down and I took out all these loans at the height and now I'm really in a pinch. Then you end up selling at the bottom when really you need to be buying, and you need to be able to ride out these drawdowns. So the same way with trading, if you've got $1,000 in your account and you're trading in one regular ES contract, you don't get many stop outs before you've kind of reached your limit, and then you get kicked out and then you got to add more money to the account. So better to trade smaller, be able to withstand the drawdown, come out the other side, and then the drawdown isn't really a big deal. It's just part of, it's like if you owned a retail store and um, you had uh, a slow morning and then five people came in and wanted to return something. You got to have enough cash in your drawer to process those returns, or figuratively, enough cash in your account to process returns. You might have five people come in that afternoon, and let's just say a bike shop, for example, and then buy five bikes. But what if someone came in, or three people came in and wanted to return three bikes right off the bat? You got to be able to sustain that drawdown. So trading is the same way. You want to get through, be able to cover the hard times, or those drawdowns, in order to get out the other side. And that was the Bill Gates approach at Microsoft, having a year of cash on hand so that they weren't worried about being able to pay employee, make payroll, and cover the bills. And then that allowed them to be more creative, think better, have less stress, and be able to kind of develop innovative, at the time, innovative products and solutions. So still in that tick divergence. Um, our next halfway back, bigger halfway back, really be another full halfway back of the day. Um, yeah, kind of caught most of the move down here, so not really going to press too hard to catch another leg if it doesn't set up. See, the 44.14 long. So really the only thing you have going against you there is a tick divergence, which just means we could continue to make new lows until uh, we get a low tick at lows. Taking the 14 even gives you a 12 stop, so that's fine. The 2 points is outside the 61.8. You broke the swing high and broke the opposing, so that's pretty much meets all the criteria for a counter trend long. Um, if you get through keeping your stop alone through this kind of little triangle here, keeping it at -2, then you can start tightening your stop on the way up. It gets a little bit, the next retracement's a little bigger when this initial retracement is bigger, obviously, but not a huge deal. Um, yeah, breaking this 61.8 was important. I wouldn't have taken it. Um, I wouldn't like this as a long if you didn't break the 61.8. The nicey tick is sort of just a supportive addition. Like you could have a hammer down at lows without a low tick at lows, and I would still take that. It doesn't have to have a low tick. The nicey tick is just your supportive indicator, if you will, or support tool. The other thing that's important about this as a kind of short-term reversal, or more likely short-term reversal, is the time. We're at an hour in is when we kind of set up here, and so that's an hour into the day. We've already had our big move to the downside in this case, and so getting a bounce to the upside around that hour mark is more likely because of the time of day. So as long as you meet the criteria of breaking the 61.8, if you're going to take a counter trend trade, if you're going to go with the trend, then just making sure that you're taking a retracement in the trend. In that case, if I was looking to take a short, I would absolutely not want a low tick at lows, because that could mean that we're at the low of the day, and I wouldn't want to be shorting into the low of the day. By definition, if we were down in a low tick, that means the downtrend was probably pretty long and extensive, in which case it was today. So taking a short down here, especially if it was a low tick at lows, but shorting down here knowing that we already fell 20 points, a little late to the party. think I'll wrap it up here. Nice 20 pointer, 15-minute, doing its thing, serving its purpose. Should continue with some bigger moves this week with Jerome Powell speaking, as we said. Yeah, we'll go from there. Everything he says is going to be turned towards the next Fed meeting, but there's also a good amount of bank discussion this week too. So this is what our next halfway back on the daily would look like. It's got a nice shelf here, 67 on top of this consolidation, and then this section of highs here too. So we'll see, but more than likely, a small pullback. 43.75 is that negative 23 that was already traded. So pull back to there, maybe some consolidation, and then a move up towards, gosh, at this point, we could very well be talking about all-time highs again. So if you have questions, feel free to drop in the Discord or shoot me an email, tim@eMoneyMind. I hope you have a great week, great shortened week, and I'll talk to everybody soon.